There you go. All right. You guys know that system, right? You know, when you clap and then the kids clap, and so we learned that from my kids in elementary school. Good morning, everyone, and welcome to the November edition of the Southwest Venture Forum. So good to see everyone. My name is Simon Mack. I'm the Executive Director of the Caruth Institute for Entrepreneurship, the host for this morning's event. Like I said, it's so good to be back in person again and feel the dynamicism and the energy that's in this room. Today is Veterans Day, and we want to give a special shout out to all the veterans in the audience. And so if you are a veteran, please stand to be recognized. Now stay standing. If you are a family member of a veteran, please stand to be recognized as well. Oh, look at this. Outstanding. All right, thank you so much for your presence this morning. Okay, please note that this event is being recorded and will be posted on our YouTube channel called Cox Caruth Institute. So check us out on our YouTube channel. The Southwest Venture Forum is a nonprofit program of the SMU Cox Caruth Institute for Entrepreneurship. And we really do appreciate the support of the businesses in the Dallas community. Our event sponsors today are Blue Crest Financial Alliances and The Studio, who is recording our program this morning. Our media sponsor is the Dallas Business Journal. So thank you, Blue Crest, The Studio, and DBJ for your support of the November Southwest Venture Forum. If you are interested in sponsoring our January event, contact us. Our information is on our website, smu.edu/SWVF. I also want to thank the Southwest Venture Forum Program Committee, who helped us create programs like the one that we have this morning. Let me go ahead and recognize all the members of this committee. Pat Hamner. Is Pat here today? Pat Hamner? All right. John Holtzgravy? No. David Matthews. I know he's here. All right, David. Bill Rolley. John Terry? And Hubert Zaitchik. And there's Hubert. All right. The program committee are the folks that help us think about ideas. And so if you have ideas that you would like us to present as part of the Southwest Venture Forum, let us know, and we'll get that done for you. Okay, let's go ahead and get the program started with our entrepreneur presentations. We have two outstanding entrepreneurs this morning who will give 5-minute pitches on their startups. Entrepreneur number one is Adam Cohen, founder and CEO of Now Cuisine. Adam, you've got 5 minutes. Come on down.
Let me start a little bit here. First of all, it's an honor to be here, and thank you for your attention. What I'm going to talk about today is something that occurred to me back in the late 80s, the idea that robotics could eventually make possible better access, so essentially democratize access to restaurant quality, nutritious food. And I'd like to tell you about the company that I'm building to try to make that possible at some point. Okay, that's it, but let me go back one slide. There we go. We just have to get it up there. Okay, wonderful. All right. Okay, so let's talk about where things are today. So where things are today is that a lot of people have trouble getting access to quality food. Often you have to travel to a restaurant or a grocery, or perhaps you pay someone else to bring the food to you. The other thing is that a result of that inconvenience, we eat things that we probably shouldn't eat so much, and there are multiple consequences to that. Now, meanwhile, restaurants have their own set of problems. They find it difficult to reach certain customers. They, when they use delivery services, they find that their profits are really slashed. And right now, particularly, they're in a tremendous struggle to hire employees. So we have a different approach to this that we think that can solve a lot of these problems. We call it distributed dining, and the idea is that since people are nearly everywhere, shouldn't quality food also be nearly everywhere? And the idea here is that if you're in an office building, you want a lunch, why can't you get a customized poke bowl right in your building, in the lobby? If you're in a dorm and it's 10 o'clock and you're studying for an exam, why can't you go down the hall and get tacos? If you're in an apartment building and you'd like to have a custom yogurt parfait for breakfast before you leave for work, it should be possible to do that. So the idea here is to figure out what goes on in say a fast casual restaurant and try to automate part of it. So what goes on is really two steps. The staff prepare ingredients, and then those ingredients are assembled and plated for someone behind the counter, and of course there's a transaction that's done as well. So this is what you'll see if you walk into a Chipotle, although you won't see the kitchen stuff. We believe that you can actually take step number 2 and fully automate it, and also do it in a much smaller space and put essentially a kiosk just about anywhere doing that function. So the idea here is that we're going to build a network of these autonomous, robotically powered, AI-powered kiosks that can go anywhere, a network that can be scaled very easily, and a network of kiosks that provide hot food that is freshly made, made to order, customizable, and restaurant quality. So why do this? Well, for one thing, people, you and I, can get food that is better quality, more affordable, and get it quickly, and we can get it any time of day or night. Restaurants, meanwhile, will be able to sell more. They'll be able to increase their profitability, especially compared to delivery. They won't have to hire new people, which they can't hire anyway, and they'll take on less risk. Then they'll be able to expand their reach, because not only will they have the traditional channels for selling food, they'll have a new one, which is selling it remotely through these kiosks. So this may sound like vaporware to some of you, but in fact, I built the first generation kiosk in my garage and had it out there serving some really good meals to people in 2 Dallas co-working spaces. So we believe we can make money with this. The business model is known as robotics as a service, and a lot of robotics companies are using this approach. And we're going to be looking at 2 revenue streams: subscriptions paid by restaurants, and also a commission on each meal that is sold. And the idea here is that we will focus on being a technology provider. We'll go off and find contract manufacturers, we're already working on that, to build these machines, mass produce them, and we'll finance them through lease financing. And others will take on the day-to-day activities. So we believe this is a huge opportunity. The restaurant industry itself was almost $900 billion, or was supposed to be $900 billion last year. But of course, COVID knocked that down quite a bit, like $250 billion. In any case, it's a big industry. What we're focusing on is the fast casual segment, and particularly brands that can do food in a bowl format. So we're talking poke bowls and burrito bowls and rice bowls and, of course, grain bowls. So we focusing on just like the top 5 of 50 players in that market. We've calculated a serviceable addressable market of around $500 million. If we go beyond bowls, we can get up to around a $5 billion TAM, we think. So how do we get to market? Well, the basic idea is to run pilots with restaurants and then go on and implement long-term contracts. And where do we put these machines? Well, we're going to start in multifamily residence buildings, apartments and condos, and also in office buildings. So people are already looking to do this. We recently signed a deal with Freebirds, which is really the #2 Mexican chain in Texas. And we've got a lot of press for that, and we basically have a strategic partnership with a PO for a pilot. We also have LOIs for pilots with 2 other brands. And our pipeline involves a lot of okay, time is up, okay. All right, fine.
Zoom, so we're trying to get back on all of this, right? At least we didn't have anybody say, "Hey, you're on mute," Okay, before I ask the second entrepreneur to come up, I've got some announcements to make. The first announcement is if you take your handout today and go to the back of the handout, you have information about our January event. Can you believe it's going to be January 2022? All right, the next time that we meet. It is going to be our annual venture capital update, and our keynote speaker is Bobby Franklin. He'll come down from Washington, D.C. He's the president of the National Venture Capital Association, so he's the person who researches and advocates for venture capital on Capitol Hill. And so please make sure that you have this on your calendar, and we look forward to seeing you in 2022. The other announcement that I have is that we are celebrating our 31st anniversary of the Dallas 100 Awards, 100 fastest growing privately held companies here in the Dallas area. We are having our awards gala next Thursday, a week from now, and these are 100 companies that have had 3 consecutive years of growth. This little flyer on your desk talks about the event. We want to invite everybody to come on down and celebrate with us next Thursday night at the Omni Hotel. We will give you a code to register for a $20 discount. See Nancy Hong for the discount code, but we would love to have you come and join and celebrate these 100 COVID-busting companies here in the Dallas area, all right? So it's going to be a lot of fun. All right, entrepreneur number 2 is Fox Holt. Fox is the CEO of Vigilant. Fox, you've got 5 minutes. Come on down.
Thank you, thank you. So unfortunately, Dr. Peter Beck, who was supposed to be here presenting, he is a disabled veteran. He is an anesthesiologist as well and got stuck in a case at Parkland. So I'm filling in. So Vigilant. Vigilant is focusing on helping nurses. So in America, as we all know, nurses have a huge shortage right now. COVID-19 extenuated and created a much bigger problem because a lot of the baby boomer nurses have retired early. In 2018, there were many warning bells saying there's going to be a nursing problem, and it's just compounding. And so we are here to help those nurses streamline and automate a lot of the tasks associated with drug delivery and drug safety steps and the documentation of drugs specifically prepared outside the pharmacy. So when a drug is prepared inside the pharmacy, which is about 75% of the time, everything's very smooth. But when it's prepared outside the pharmacy by nurses in the operating room, in the ER, and the ICU, it's not a very good process. And it's a lot of times manual handwritten on pre-printed labels, which might or might not be around. And so this is an example of what we're talking about. This is actually a good situation. A lot of time IV lines are not labeled. Approximately 60% of the time IV lines are labeled, and I would hate to say that most of those times it's illegible. This is what we can do. Very similarly, in dressings, can't read it, and if these things aren't changed appropriately, then staph infection and central line blood infection occur, which cause the hospital even more money, and it's problematic. And so we help in all these kind of categories. And so here's an example of our product. We make it extremely simple. We put software directly on the printer, or we have an Android app and/or Apple app. And so this is actually 3 labels that go on the IV line. This is just one example. We have syringe labels as well. And so this saves time to nurses, about 1 to 2 minutes per IV line. A COVID patient can have up to 15, 16 lines coming in. So it saves a lot of time. Additionally, there are deaths that occur. There was a big study recently in July about a person who died because a nurse started the wrong pump. She thought she was starting a lactated Ringer's pump. Instead, she started an opioid pump and caused the patient to expire. But as we all know, data is huge, and so where we sell a lot of the information is in the data. And so compliance reporting, drug diversion reporting, and drug inventories to the pharmacy. We also can integrate into the EMRs and just print on demand as opposed to all sorts of pre-printed forms and labels. And so we have recently gone to a unique model, a freemium model, which is not done in B2B very much, but it's a razor blade model. We sell these labels, and we have a 4-month return on investment for giving the printer to the hospital. And so ICU nurses are really struggling, right? They're overworked. There's 24,000 or 34,000 nurses at Kaiser who are going on strike today. And so this comes in and saving hundreds of hours in a hospital system. Let's get it in, because the amount of time it takes to get into a hospital system is forever. I mean, the loophole, there are many governments. And so why go through the process of capital purchases if we can make our money back in 4 months, and from there it's gravy? But then we plan to come over the top and sell the reporting, the data, to provide, what is really the valuable. And also, lastly, the EMR integrations. So Kaiser Permanente, they had one hospital that just said, we're going hospital-wide with your product. That was one of our first customers with our new IV tube labeling product. We started with the syringe labeling, and this is a newer product. This new freemium model has got us into trials into Baylor Scott and White, UHS, CHI. It's moving tremendously fast, and we're getting outstanding feedback from nurses. So the team is very diverse. I was an investment banker, Cornell MBA, done a couple startups, raised $4 million before in my first startup. Dr. Peter Beck, he's a double E from Johns Hopkins and been an anesthesiologist for 17 years. Jeff Fontaine, who connected the two of us, we started our careers together selling printers to hospitals and pharmacies 20 years ago at Lexmark International. He's been in healthcare marketing since 2000. And Sergey Ilyev, who is our developer, and he's spectacular. So thank you.
I'm going to do it here too. I'm not going to stand behind the podium. I'm just going to stand right here. All right. Well, I'm delighted to introduce a very exciting and timely discussion this morning on Dallas Venture Financing Update. We have an outstanding panel of 3 Dallas investors who will share with us what we are seeing in the Dallas marketplace. We will have about 10 minutes at the end of the discussion to respond to audience questions. Bill Rolley from Texas Capital Bank is our moderator this morning. Bill, I hand this discussion over to you.
Thank you, Simon. Everybody hear me all right? Is the mic on? We good? All right, my name is Bill Rolley. I'm with Texas Capital Bank. I've been on the committee for over 10 years, and I'm pleased to be here today to help moderate our panel. I'd like to thank everybody for coming in attendance today. It's great to see a good crowd. I see a lot of familiar faces. I'd also like to give a shout out to the veterans. I know at our organization we had a special day to recognize them yesterday. These people hold a special place in my heart. My father was a veteran, served in World War II. He's since passed, but he was very proud of everything that he did for the country, and so I just want to mention that as well. When our panel got together and talked, it's been a number of years since we discussed fundraising for startup companies. We thought this would be very topical. Hubert, another committee member, today is pitch day for you, right? For healthcare wildcatters. Very big day. I'm sure all of those people will be looking for money soon, and wanting to know information on how the best way to handle that is. We hear that the market's very active right now for fundraising. So we hope we can provide some topical updates. And with the great panel that we put together, I know these gentlemen, they have money today to invest. One of them, the banker has the money today, although the bank's closed today, so the money's available tomorrow, but it's okay. But we're here. Just had to make note, we're celebrating Veterans Day. One of them is fundraising right now to raise additional money, and they are all actively making investments today. We were joking about how many deals they look at each year. I think someone said 500 to maybe up to 1,000 at some point in time. That's how many deals they look at a year, which is amazing. So these gentlemen have a lot of great experience, and what we're going to do today is I'm going to introduce them one at a time. We're going to give them each a few minutes to talk about their firm and their team and some of their experience. And then when we get done with all three of them, then we'll have a Q&A. I've got a number of questions that I think will be very helpful for everyone to listen in on. And then we'll open up for questions like Simon said. So our first panelist, there's no particular order, but Dave, we're going to go with you first. So Dave Matthews.
Maybe there is then.
Founding Managing Director of RevTech Ventures. David started RevTech, and it's an early-stage venture capital firm that invests in retail technology, focusing on entrepreneurs and technology innovation in the retail space. They've been a catalyst for over $250 million of startup capitalization. Their focus is to accelerate the growth of top-tier retail tech startups. Prior to joining RevTech, David was with Trailblazer Capital for 15 years, and David's a graduate of Ohio State University. So David, with you, I'll get you started.
Thank you, Bill. Appreciate it. Can everybody hear me okay?
Yep.
I'm new on the Southwest Venture Forum Committee, and I guess being on this panel is like a rite of initiation or something. Good. And I started my first startup company the same day I started the MBA program at SMU back in 1991, so 30 years ago. And the startup company took off, and so it put me in an entrepreneur and then later a venture capital role. But
And a Dallas 100 winner.
Dallas 100 for 5 years straight back in the 90s. So. I'm going to go back next week just for old time's sake. But anyway, RevTech, as Bill mentioned, is a very early stage seed capital venture firm based here in Dallas, focused at the intersection of retail and technology, which is a real robust, busy area these days, a close cousin to FinTech, which may be kind of the leader for fundraising currently. But FinTech and retail tech are very close cousins around commerce and the consumer. We mentioned the catalyst to capital. We managed just under 50 million of capital today. We've deployed 10 million cumulatively at this point through RevTech, and that's a very small amount, but it's been a catalyst now. Yeah, the stat what you said was 250 million, but this year it's grown to over 500 million, $500 million of total funding of these companies that we've invested in when they were in their infancy. So that's our role, is help companies get through their infancy into childhood and then go raise the big money from the big institutional firms like these guys. I have a small team, very focused, but all around Rachel's been focused in biz dev and is now working on her own startup in-house. Locke, I have an associate. He does all the heavy lifting of processing the deal flow and investor reporting and investment management, making sure we're current on everything. We have an accountant, and we have a MBA student that's starting a new initiative, a brand launchpad that we just kicked off this month. So this has been a terrific year for exits and for up rounds. So it is helping to propel lots and lots of capital pouring into venture now across the space. And so this year we've had exits, 1 for cash and 3 for stock. We prefer ones for cash very much. So exits for stock is kind of like taking a whole new set of risk all over again. But when we exited the Citizenry, which is a local e-commerce company, we actually exited our seed capital round participation through a secondary with a very nice outcome. But we held our Series A funding as the company closed on a big Series B earlier this year. So our portfolio that have raised big up rounds this year on the right-hand side, and in the middle there, Citizenry, Neighborhood Goods, Cook List, Arcade, Pressed Roots, are all Dallas companies. So very pleased to see. We invest nationally, very pleased to see all this funding coming into companies here locally. Our themes are all around where commerce, where the consumer and technology come together. So big themes we're seeing are what you as consumers are thinking about as you're shopping. Sustainability, re-commerce, which is putting more life around goods for a second life or even a third life. Social commerce, social media, influencer marketing is really having a profound effect on creating today's new brands. It's really interesting. You have somebody that'll get 1 million views, 10 million views, and all of a sudden they become their own brand. Last mile delivery has been huge. Just look at GoPuff and Delivery Hero and DoorDash, all these things. And then supply chain transparency and automation, making things, don't we wish that was all working right today, huh? And then lastly on us, RevTech emanates out of the Wiley family office. The Wiley family built the majority of its wealth through retailing with companies like Michael's Arts and Crafts, which the family exited 15 years ago, but was a big home run. And then Sterling Commerce was an e-commerce platform early on, back in the 80s and 90s, help make companies like Walmart digitize their entire purchase and vendor process. So it's not surprising that us coming out of a family office that has all that knowledge and experience around it would focus here. But our portfolio construction, the brands is kind of the straight up line, and then the technologies are that line that's flat line for a long time, maybe permanently, but you hopefully will swing up with mass adoption. And we like to balance those two. Brands are more a linear growth, and then technologies are more an exponential growth component. That's a little unusual, but given kind of the backdrop of the family office, we like that because it gives kind of a protected downside exposure as well as still, having a lot of upside. And that's RevTech. I think that's all I had. Thank you.
David, thanks for everything you've done over the years for our community and your investments. We appreciate that. All right, next up, J.R. Garcia in the middle, principal at Green Park and Golf Ventures. JR joined Green Park and Golf Ventures at its inception, has been instrumental in the evolution of the firm since the first investment. He leads their financing and portfolio strategy efforts, as well as overseeing fund management. JR attended Notre Dame. I see he's got his little tag on there for his undergraduate degree, but he is an SMU MBA graduate. He also mentors a number of SMU MBA students and serves on the selection committee for multiple incubators and accelerator efforts here in Dallas. So JR, I'll turn it over to you.
All right. Good morning, everybody. And yeah, I should have worn an SMU sweater given the Dallas function and tie in here, but
We'll get you a new one.
have to go shopping. Yeah, thank you. Well, yeah, good to be here. GPG Venture has been with them since about 10 years now, so since the very kind of beginning of it all. Like David said, kind of born out of a family office, so we have our roots there and kind of evolved organically over the last decade or so. But in short, we're an early stage venture capital firm. So these are the lovely folks I get to work with every day. The top two partners, Carl and Clay, are the founding partners, and they have their roots in healthcare. So Clay's a doctor, emergency medicine physician. Carl is a lifelong healthcare entrepreneur. They had a series of companies that they created and then sold them. And then I joined them kind of right out of SMU with a blank slate. And they said, let's do something together. And we didn't know what that meant. And it turned into this firm. So that's kind of the history of it. Lauren joined us about 4 years ago. She's our chief scientist of the group. PhD in neuroscience, but really strong molecular biology background. It kind of keeps us grounded and on the right track in the deep sciences. So we invest 85% in healthcare. That slide's really hard to read, but I can talk through it all here. It kind of gives you our history going back to kind of the medical edge days with Carl and Clay. But so we invest 85% of the time in healthcare, and that's a pretty broad definition of healthcare. That's in consumer goods, such as sunscreens or toothpaste or kind of healthcare-focused consumer goods, usually with a new delivery channel or channel kind of go-to-market. We do medical devices, both 510K, which is kind of a light FDA pathway, and then PMA, which is a higher kind of FDA burden kind of pathway. Drug development companies, both new molecules and reformulations of molecules going back to market, and then software in healthcare. Much like Vigilant, things that help the workflow of doctors or patients or systems. The only thing we don't really get into is B2C, consumer-oriented apps or whatnot, things like that, or wearables. We don't really go to that world. But other than that, we're game. And then 15% of the time is in other areas. David and I have done a deal together outside healthcare. We do mainly B2B SaaS, but we're open to anything. So we have about $100 million that has been deployed so far to date. About 20% of that is from the partners, so Carl, Clay, other employees, and our families. So we're about 20% of all the money. And the way that we work is mainly through an SPV model. So we find a company that we want to invest in, and then we share that with a couple hundred of our closest friends who go on this journey with us. And they kind of get a term sheet, a deck, a presentation, and they hear we're investing $250,000 of our own money. So that has resulted in about 100 unique companies that we have invested in to date. 65 of those are still going. We have 15 positive exits, more than 1x, and sometimes many X's back to the LPs, which is great. 4 companies trade publicly. We have 1 SPAC, which has been a lot of fun to be involved with on the GP side, and so far doing well. And about $23 million has been returned to investors, which is always nice. So that's a quick snapshot of us and the history. 2 more things I'll mention. We have partnerships with Hubert Health Wildcatters and a medical device incubator in San Francisco. So we're directly and indirectly on the cap table of about 200 or so unique companies across the United States. Then we launched our first opportunities fund in 2017, and that was a $10 million vehicle, which we used mainly to invest in pro rata rounds or follow-on rounds of companies that we invested in. And we are currently investing out of a second fund, which is about $17 million right now, with a goal of about $30 million to be raised and deployed. So looking back at our 2021 so far, we invested in 4 new companies. 2 of those are Dallas-based. One is Recuro, which you might have seen some headlines on recently. They did a $17 million Series A, which we participated in. And then Alto, which is a rideshare company, and that's an example of a non-healthcare deal. That had some relationship and some other aspects we got involved with, but they raised a $40 or $45 million kind of Series B, which we participated in. So half of our new deals this year are Dallas or Dallas-oriented. The 2 other ones are one Philadelphia-based, Prolocor, which is a cardiovascular risk assessment test, and then Gravitas, which is West Coast, kind of a Bay Area company. So we'll invest across the United States. About 40% of our deals are in Texas, just given our relationships, our history, our investor base. And then the theme for this year has been a lot of follow-on. So you can see we did 20 follow-on investments this year, and at big up round. So we look smart on paper, which is always nice, but not dollars back to investors. And that's just a sampling right there. Kind of gives you a good idea. Gregor's a diagnostic. We have a spine implant. We have a single-cell sequencing company up there, a device. So it kind of gives you a good feel of what we invest in. But it's been a very busy year. We have invested about $30 million over the past 12 months or so, and probably add a deal or 2 before the end of the year if we get busy. And that's the very short story about us and myself.
Not to date any of us, but I banked one of your partners, Carl, back in the day at Medical Edge, and that was the launching pad for you guys. That was sort of fun, so very good. So thank you for all that you do to invest in our community. We really appreciate it. All right, lastly, we have Jeff Williams on the far end. He's managing partner at Interlock Partners. Jeff has more than 25 years of management, operational, investing experience, including 17 years investing in early and late stage companies. Collectively, he's managed, sold, and invested in over $1 billion worth of companies over 2 decades. Prior to Interlock, Jeff was with Covera Ventures for 16 years. He's also a board member at UTD's Institute Advisory, at UTD on their Dallas Institute Advisory Board, and the SMU Cox School of Business Venture Fund, where he's a frequent lecturer and guest speaker. Jeff's a graduate of UTD. So with that, Jeff, I'll turn it over to you.
So in my life, yeah. So I'm getting over allergies here, so if I lose a voice here and there, that's the reason why. So good morning, everybody. Jeff Williams, Interlock Partners. As Bill said, I've been doing this quite a long time. I'm probably the old man in the room here, so to speak, in terms of venture. So as Bill mentioned, real quick, I'll go through my background. Covera Ventures is about a 16-year-old fund. It was backed by the Hunt family here in town, Ray Hunt. Chris used to be involved in this forum quite frequently. That fund sort of ended life about 2011, 2012. I became an active angel mentor, coach to startups. Loved really doing that in Austin and Dallas. And somehow I got roped back into the venture business in 2015 to start Interlock. And Interlock was really started off to be a Dallas-focused seed-only fund. The capital behind Interlock is all really friends and family, ex-venture guys. John Jaggers, for instance, with Seven Rosen Funds, a big investor in our fund. And so really just lead the way to start investing really in the Dallas market. And what you'll see here in a few minutes when I go through the slides is that sort of evolved into a bigger play, a bigger strategy, and more of now of a national approach to the venture market. Just because when you'll see the partnership we built, our networks are just, both coasts, strong relationships, cultivating deal flow, putting money to work. And so the strategy has sort of evolved since we started. So real quickly, we got a great team. Harry Hawks is our New York partner. I won't go through all the details here. I know these are eye charts, but Harry's a media, ed tech executive, got a long background. He helped turn around K-12 back in the day, took it from, I think it was 60 million to over 250 million in revenue. He's an LSU guy, loves LSU football, NBA program. He's a great guy, but he bounces between New York and Dallas for us. In fact, he's in New York today. Carl Sparks, some of you may know Carl. Carl's the former CEO of Travelocity, CMO of Expedia, Gilt Group, BCG, Harvard Scholar. He's a great guy, he's a great friend. Carl actually joined us in the last 2 years. Carl's an old friend of mine. We enjoy two things together, fly fishing and cars. And so he joined the firm. He was an investor in Fund 1. He's one of the friends and family in the round. And he liked what he saw in Fund 1, and we had an opportunity to bring him on as we launched Fund 2 here, and I'll talk about that in a minute. Inabot's our ace in the hole. She's a SMU MBA grad. She's incredible. She went to college at 14. She has an undergrad in mathematics, spent most of her time in the early days of her career in Eastern Europe and Russia, working with family offices there. She knows 7 languages. She went and got her CFA because she was bored. That tells you what kind of person she is. Anybody that wants to do that may need to go get some therapy, which I've told her, by the way. And then again, there's my background. Really, mostly the last 20 years spent. Dave and I were joking before we come up here that he and I really started in the venture business about the same time, and of all time frames, it was the year 2000. So the crash is going on, and we made the great decision to jump into venture capital. So my wife at the time wondered what the heck I was doing. But anyway, it's just been a great run. And let me jump over here real quick. So just a little bit of detail there. Covera was a really successful run. It was a $100 million fund, again, backed by the Ray Hunt here. He's a great partner. If Chris was here, it's a great family. They're a great family to be associated with. Graduated UTD, done a lot of work in operations. A few of the companies that I sit on the board of today, Zen Business, if you follow any of the tech news in Texas, Zen Business just announced yesterday a $200 million round and a $1.7 billion valuation. So it's the largest unicorn company of 2021 out of Austin. So we're pretty excited to be a part of that. I'm on the board of that company with some outstanding folks from Graycroft. So what do? We're a very traditional early stage venture firm. I would say the one theme that if you looked at all of our current portfolio companies, we only invest in things that we know. And that sounds really simple, but I've been doing this a long time, and people who do frontier investing and horizon investing, as they call them, can get themselves in trouble pretty quickly. So what we do is, if you go back into the skill set of our team, we only look at things that we can really bring value. Everybody says that, but we really do. And if you interviewed all the CEOs in our current fund, we're very involved in these companies. For instance, I'm on like I said, the board of Zen Business. We've helped them build out their C-level team. We've helped them just raise money. We brought in $15-20 million through our network for this current round. And so, it's really a very traditional early stage approach. We prefer to be Series A. We have done some seed deals, but we're moving away from that in the Fund 2 just because Fund 1 was a much smaller fund, and we were able to get in some of these deals early, get a seat at the table, as we call it, and then grow with the company over the multiple follow-on rounds. And so it's a very traditional sort of basic, but the core theme is we have to bring real value to you. Here's sort of a map of where the companies that we've invested in to date in Fund 1. You'll see here in Dallas, Rechat. I'm not sure if anybody's familiar with Rechat. It's a real estate technology play. We were one of the early investors, along with actually David Hunt, locally in that from a seed level. Actually, a PowerPoint, to be honest with you. Starbucks up in Uptown, crazy. Zen Business, I mentioned. Hanger is actually acquired by AirMap, and then Moto Payments is a local fintech deal. So we've made a couple of investments here in Dallas. There's sort of a breakout of the types of investments we've made. You've got everything from fintech, digital media, which is Carl's background, advertising. Robotics is really the drone industry, which was the old Hanger technology. So we've done a little bit in drones. Real estate tech is ReChat, and you'll see the breakout by New York, Texas, and California, and that just maps right to all of our relative backgrounds and networks, so no surprise there. So this is a really interesting slide. It's complicated, but I'll just hit it at a high level. On the right, you've got the markets that we all have experience in for the most part. In the middle, you've got all the different types of technologies that are in the legacy marketplace and in some of these legacy companies that we see. And on the left is sort of the enabling technologies that's so bringing transformative change, if you will, into some of these newer companies and legacy companies. And that's really where we spend most of our time. So Black Crow is an example of our first Fund 2 company. It's a targeting sort of advertising company, really early stage. We're in that with Primary Ventures. They're out in New York. VidMob is a content company in Fund 1 that's doing quite well. And so as we look across how we invest, again, we look at some of these enabling technologies. Everybody says they have AI, everybody says they have ML, but we really get into the bowels of what that really means and what change is that really going to bring to an existing process, if you will, for the most part. So a couple of our investors, folks we've done business with over the last really 2.5 years. The fund's only really just coming up on 3 years old, so we've got some great partners. What's important here to note is outside some of the venture and private equity, these are large family offices in some cases, and we've got a lot of strategic. So if we look at just VidMob as an example, it's a content play. It's changing the way pre-rolled ads are happening and in marketing and advertising is happening. The lead of the last round was Adobe. And so Adobe came and wrote a big check and led the round. So we've got a lot of strategic. We like to say that most of the portfolio companies that we have today, the buyer is most likely already on the cap table, right? They're already a part of the company. They understand the business. But and you'll notice too, Hero, some of these are all international based companies. So we've got a distribution channel that goes really worldwide through the networks of the partnership. So, and that's quickly us.
And Jeff, thank you for everything that you've done for our community and investing in a number of great companies. So as everyone can tell, we could probably be here for 3 hours and talk about all the deals that they've done and all the great experience. So, but I've pulled together some questions that I just sort of wanted to run by each of them, give a quick brief answer, play off of each other, some stories. And let's just start out. I'll start out here on the left side. But over the last 6 to 12 months, what would be a recent trend that you've seen in startup fundraising that's a little different than we've had? David?
A recent trend in startup fundraising?
Any recent trends you got?
Well, I'm focused around technology for retail, so it's those themes I showed you up there. I mean, the trend line that's been continuing for 3 or 4 years now is valuations rising steadily, and that's happening from the biggest funds in these big SPACs, but it rolls all the way down to, smaller firms in Middle America and what we're looking at.
Okay. Yeah, I mean, in a word, money is just everywhere. I mean, you're seeing, huge rounds. I mean, Zen Business, as an example, huge rounds. We had a number of companies that were raising, Q1, Q2, 2020. Had a slight delay, but came roaring back. I mean, Q3, Q4 last year, just, portfolio companies raising $50 to $70 million, routinely, and probably just seeing that accelerate over 21, year to date. So there's a theme. It's just money and deals, and timelines are compressed. So you're seeing pitches to term sheets to actual closing round just get really compressed, whereas before people had a little more time, and now you're seeing new players jump in and get deals done. So it makes our lives busier and being reactive to portfolio companies and newcos. So that's the theme from our vantage.
What we're seeing is a lot of seed deals, seed level deals, so first time entrepreneurs. I think COVID has really exposed the 40-hour week work for a lot of folks. And so they figure, I'm done by 10:30, what else am I going to do the rest of my day? And so we're seeing a lot of sort of part-time, full-time employees trying to start companies. And so we have a fairly active seed pipeline, if you will. And like I mentioned earlier, that's not really the focus of the second fund. And what we do is we push those out to partners who really are active in the seed space. And we sort of we just basically monitor those companies throughout the seed process, kind of like what David does, and as he says, gets them to childhood. But we're seeing a real uptick in first-time entrepreneurs, and we're seeing quite a few out of Dallas. We're actually it was yesterday, we're meeting with companies here in Dallas that follow that profile of seed level. I would agree with JR, the amount of capital out there is the most I've seen in a very, very long time. There's a tremendous amount of capital looking for an investment opportunity, and guys like us are able to raise money faster than ever before. Our second fund's already halfway committed, and we've really scratched the surface of an outreach for it. So the asset class is doing incredibly well right now. If you look at all the returns of all of our investors, which are pension funds, endowments, family offices, individuals, they're putting up record IRRs and returns for the investors. So the asset class is hot, which is just sort of fueling. It pushes more capital into the market, and but you still got to make the threshold. You've got to have the track record, the experience. It's still hard for first-time fund managers, but we're seeing, I guess, coming back to the original question, we're just seeing an uptick in first-time entrepreneurs.
And Bill, I think this cultural shift we've seen the last couple of years of people working more from home, a lot of you in the audience are probably part of this, as well as probably us as well, of working all from home or some from home. It really has profound effect across real estate, across retail and commerce, this last mile delivery theme. All these things are really making profound changes and disruptions.
Okay. Yeah, it's interesting. We see this not only just in venture space, but everywhere. It seems like there's a market where there's a lot of selling activity as well as startups, and so they keep funding each other. The funds get deployed quicker, and so let's hope that cycle continues.
The IPO market and the SPAC market, I mean, people are looking for liquidity at the same time, and so the cycle in our little world is running, to Jared's point, it seems so compressed now. If you look at Zen Business, we first invested in 2019, it's 2021, and they've already raised $250 million. It's great, the company's doing wonderful, but that's the velocity of these deal tracks right now. They're just so quickly.
So Jeff, you'd mentioned that you're seeing a lot more local deals, and can you guys put it in a percentage, like how many are Dallas or the greater Dallas area based, or even North Texas versus out of state?
About half of mine are Texas, primarily Dallas and Austin. And it's funny looking at our map of geography. After Texas, it's California and New York for us, but at least half, and it's split between Dallas and Austin.
Percentage-wise, I think I mentioned 40% in Texas of deals we invested in. Dallas is maybe, if I had to hazard a guess, probably should look this up, maybe 15-20%, of that. And I think we're seeing some first-time entrepreneurs and new companies in Dallas, and you're seeing a lot of activity with Pegasus Park and people moving to town here. So you're seeing and some exits, right? Exits help everybody. So Southwestern has some good exits from New Drugs, Tasha, Peloton, et cetera, right? That kind of fuel interest, kind of give confidence to other entrepreneurs, kind of take an asset or technology to market and build a company around it. So we're seeing maybe not a huge uptrend, but maybe a slight uptrend in healthcare anyway, kind of specifically. And then like Alto, seeing some bigger rounds kind of come together here of established businesses that are a little bit later stage that we kind of get involved with. So Dallas is probably not as hot as everywhere else, but on an uptrend is kind of how I would put it. And we're kind of seeing generally good deal flow. Yeah.
Well, I would say, again, looking back over 2 decades of being out of Dallas, the piece that's been broken for a long time is the availability of capital. And there's fewer guys like us, unfortunately, in Dallas than there once was. And I'm not going to go tell the storyline, everybody knows it. But, what we see is a lot of deals in Dallas because we're one of the few firms, obviously, in town. So about half our deals are in Texas. You can see by Fund 1, it just worked out 50% actually are in Texas. And 25% of that is the companies we have here in Dallas. So, we, like I said earlier, we try to do our job in part of the ecosystem, and if it's not a fit for us, and sometimes that's based on timing, that's workload, that's things coming together like Zen Business overnight. But we try to help out and find capital for a lot of entrepreneurs and quite honestly, through family offices. We've got a fairly extensive network of family offices around our fund that are looking for deal flow. And like I mentioned, we did SPV for Zen Business, and we raised, quite a bit of capital through that SPV through family office networks that we have here. So I think the family offices have changed their view of the asset class as well, where, David and I, when we got in the business, it was hard to get capital and commitments from family offices because everybody knows traditional real estate and energy markets, and that's okay. But that's all changed with what I call the third generation in the room now, and you've got a younger generation whose appetite for investing in venture and early stage is changing. And I think that's going to drive, to JR's point, that it's taken time. I look at Dallas today and I get really excited about what it could be in 5 years, because I think the pieces are coming together, the building blocks are coming together. We got UTD, what they're doing, what you guys are doing at SMU, and it's going to take everybody. But you're going to need more guys like us, period.
All right, I know you each represent different industries, but everyone wants to know, what's the hottest space right now? Is it healthcare, technology, retail?
Oh, it's got to be retail and fintech, right, JR?
COVID put a spotlight on healthcare. I mean, God, you can't.
You better not have any LPs in the room. You better say retail. For us, I'll go first. I mean, for us, we're seeing quite a bit of activity in what they call prop tech, which is everything around sort of the real estate ecosystem and what's happening there. And you're seeing technology sort of and innovation taking place there. So we see quite a bit there. Fintech, I think David mentioned earlier, has been on fire for 3 years, if not more. And there's a tremendous amount of capital going into fintech right now. And the challenge there is you've got so many companies, it's so fragmented, it's really hard to evaluate your competition. And so we see quite a bit in media because of Harry's background and Carl's background.
We had the CEO of Alchemy here, fintech, and their valuation is larger than our bank, and they've only been around for a couple years. It's crazy, but that's how it works today. All right, how many first checks are you writing today versus add-ons? If you could give us a relative percentage or
Steady pace for me. I've done steadily with RevTech 6 to 7 initial investments each year, usually small, usually in the $100,000 range, and then follow-on investment in a subset of those. So if we do 7 initial checks, we may do follow-on much larger in 1 or 2 of those. And for us, follow-on is $500,000 to $2 or $3 million.
how about you guys?
And it varies widely year to year, and healthcare can be a particularly long game. So, we're investing 4 to 10 new deals per year. Here, I think we'll finish about 5 this year. Just as an example, we're investing in a couple companies that are 8, 9 years old, and we've invested 6, 7 times in them. So, because they're going through a very long, arduous FDA pathway. So, the things we get involved with, different than these guys, we're first in human trials or kind of phase 1 trials, and then, it's pretty simple. They have an expense line and they don't make any money, so we can kind of fairly predict they're going to raise money, 4 or 5 more times in the future. So we probably, just being in healthcare, have a heavier dose of that than a general fund. We did 20 investments this year, and that were kind of follow-ons. And those are just much larger check sizes. So as an example, Gregor Diagnostics, we just put $4.5 million into a $5.5 million round. But that company's been around for 4 years. And we kind of dripped money in, and they finally got data on 200 humans on their diagnostic test. And it's like, okay, now we're ready to go. And so it'd been maybe a total of $1 million or so into the company over 4 years. And now it's like, okay, now here's $6 million, $5.5 million total. And so they just, quintupled the amount of money in that company in the last 3 months, but it's been over 4 or 5 years. So, I think we will probably follow that trend, right? Because these companies are going to go raise dozens of millions of dollars, and we'll take down our pro rata, if not more than that.
That's it for us. The last first time check we wrote was Black Crow, and that was probably earlier this year. Based on the complexion of our Fund 1 portfolio, we spent a lot of time with that portfolio the last really 2 years. We've had 5 of the companies raise 50 million plus rounds. And as I mentioned earlier, we're really involved in that process, and we, pretty hands-on. So our portfolio is transitioning from what I'd say an early stage, traditional early stage risk profile to more of a private equity, growth, platform oriented. You've got companies like Zen Business and Vidmon, as I mentioned, and Begin, which is an education play that are, they're approaching 50, 60, 70, 80 million revenue in a very short period of time. And so we've been very involved in really follow-on investments and participating in SPVs, which are really hot right now to bring in additional capital. And you can imagine where you're a fund our size and you have your pro rata, if you will, per round. At some point, the small funds can't keep up with the bigger funds. And so we complement our investment with an SPV. But we've been doing mostly follow-ons in the existing portfolio right now.
Okay. A couple more quick questions and then we can open it up. So talk a little bit about valuations. We mentioned it a little bit. They seem to be very high. Scary.
They are.
I mean, just talk about what are the drivers and do you foresee that continuing or?
Well,
I mean, but yeah, go ahead.
Yeah, so when you've got that much capital out there, how do you compete? And you compete on valuation a lot of times. It's a complex equation because you've got folks that can't write big checks, right? And they need to put a certain amount of money to work. And then you're competing for the deals. The competition for deals is incredible right now, right? And so, again, this reminds me, I talk to some of my old venture buddies all the time, it kind of reminds me of the late 90s where we're so frothy, everything is going so quickly, and a lot of investors haven't experienced a dramatic downturn. Been there, it can really happen overnight. And so, it's scary. Sometimes you got to pinch yourself that you see some of these valuations that you do, and everybody's in the $1 billion unicorn club, and now you're talking about decacorns, and you're talking about whatever's next. And but we monitor it and you manage it, and you have to be disciplined as an investor, right? We've passed on many deals that we would like to have done just on valuation. We just can't get enough of the company, and it just didn't make any sense for us.
I think just as another component to this, we're seeing a lot more debt, like venture debt or other types of debt come into the marketplace and take a big chunk of rounds. And so a company that might raise, call it 15 to 20, they might supplement that with 5 of debt, which is interesting, right? And that plays into the valuation and how much you can buy of the company. And so it's, at the end of the day, yeah, it's a lot of money chasing deals. A little bit later stage, I think over the decade or so we've been doing this, we had kind of gone to the Series A, Series B-ish kind of route. I would say we're probably now doing maybe a barbell approach, some kind of true like seed, first type of money into a company like a Prolocor, seed round, and then doing a lot of money in a Series B. And the Series A, I think we're seeing a lot of valuation where there's proof of concept, but not, in our opinion, not enough to command the valuation they're getting. So it's kind of, we're being selective there.
Well, I'm hoping with the pandemic and the FDA's speed to, determination of drugs, that hopefully that helps the healthcare market and Hubert's companies and such, that we can speed up the timeline. I don't know. Time will tell, I guess.
For entrepreneurs in the room to kind of see to our side of the table as investors, for us, a big investment has to be able to return funds. So if we do 10 deals in a fund, any one investment has to be able to have a 10x outcome. So if that kind of pre-seed company has a thought of valuation around 100 million, it's got to be a unicorn. There's a lot more unicorns today, but not that many, and not that many in Texas. So, you have to dial it back to, okay, connect the dots back to now. How can you help us see clarity to a 10x outcome if you perform reasonably over the next 3 to 5 years? Take that and connect the dots back to today. That's kind of the thought process.
And then the last quick question is, so how do people find you? You guys are all veterans. You've been doing this for a long time. You said there aren't as many as you. Is it all networking? Is it...
Yeah, for me, I started as an accelerator. So we started with this kind of robust mentor offering for being focused on retail. it's kind of perversely worked in our favor because a lot of the big retailers headquartered here have downsized over the last several years. So we find a lot of kind of recovering retail executive talent as mentors, and those people see stuff. So that's probably our number one. The other is other accelerators that are themed around retail or fintech around the country that will bring pre-curated things to our attention. And then the other is from investments themselves. When a company we've invested in meets an entrepreneur that they know kind of fits our filter and introduce them, that's like the best, because that's somebody we've invested in saying to another entrepreneur, you should work with these guys.
Anything different for you guys?
We're partners with Hubert at Health Wildcatters, so accelerators, incubators. But David's mentioned, we funded 100 unique companies to date. So those management teams, those CEOs, those C-level guys, they're usually mentors or advisors to other companies, and we get a ton of deal flow from there. But how to find us? Our email, our website. I mean, it's not that hard. I think the hardest part is probably rising above kind of the noise, because we do get so many decks, right? And so the inboxes are just always a mess.
Aren't the studio guys doing a live stream for you or anything to get you out there on the social channels?
That's why I'm here, get more deal flow. But it's fairly easy, but it does take some time to kind of get above it, and a warm intro does help. So.
Yeah, I mean, basically it's the same with us. I mean, if you look at our team, most of it comes through, a lot of our deal flow comes through our private networks. I mean, it sounds kind of arrogant, but it's just, look at Carl. I mean, the guy ran, Travelocity. His deal flow alone is a fund strategy by itself. I mean, if you look at his personal portfolio, it's just incredible, right? So most of it, and just keeping up with that, time allocation for us and management, I think is really important. And so we see about 1,500 deals a year, and we've got to churn through those pretty quickly, but a lot of that comes from the existing networks. And how people find us is the normal approach, LinkedIn and friends. But I think it's important. I always tell entrepreneurs to find that warm introduction. Work a little harder to find the warm introduction, because we get a lot of transom deals, and we'll get deals that don't even fit our profile. We've got a website. We state our strategy. Don't send me a restaurant deal, right? I mean, just do a little bit more homework, and you'll get a little bit above that noise, if you will, have a better chance of getting above that noise if you just do a little bit of homework about the type of firms and what they're really interested in doing. And the second thing I'd say is go look at their current portfolio and see if you have to David's point, you're part of the filter, right? You're not bringing Interlock a restaurant deal. You don't see any restaurant plays in our portfolio. So, but most of it's just networks.
Well, it is a little bit of a commercial for you guys, and that's why we appreciate you so much spending time with us today. So how about a quick round for our panelists? Do we have time for a question or two? Anybody have a question?
Can you guys hear me?
Yeah.
So you say you have a lot of partnerships with incubators and accelerators. So I'm wondering, how that usually works if you're doing Series A and Series B.
How that works, I mean, for us, if we come across entrepreneurs that are too early, but we want to keep an eye on them or help out in other ways, we'll send them, make an introduction to an accelerator that we think is right, or an incubator that we have a close relationship to. As an example, I'll say Gregor again. Saw the entrepreneur, but it was really early for us to invest in. But went through Health Wildcatters. We did some seed, early round, kind of drip feed in, and ended a proper Series A here just this past year. So it's a way for us to, keep our eyes a little open, and in some cases, there are funds out there that make commitments to fund the entire accelerator class, and there's some folks out there that do that, but we're not that way.
One more down here.
Hi guys, good morning. Thanks for being here. Question for you, Dave. I saw on your slide deck something about a women or equity for women fund or something like that. I'm curious to hear more about what that is.
Yeah, so we probably half of our deal flow is women-led startups, being focused around the consumer and retail. Just a really stunning level of startups led by smart women, and about a third of our investment portfolio is women-led. And you saw my team, we're about 40% of our team. So I think for us is just recognizing the funding of women in general through venture is really pathetic. It's like low single digits, and so for us it feels like a competitive advantage to spend more time and effort there. So my colleague Rachel West and I raised a small Equity for Women fund. We've done 3 deals so far. We have room for 2 or 3 more. And our hope is that this little $1 million pool of capital does so well that we can go raise $50 million to do a lot more of it.
That's incredible.
Outstanding. All right.
All right, thank you.
Okay, that concludes our November Southwest Venture Forum. Thanks again to the sponsors, Blue Crest, the studio, and the Dallas Business Journal. Thanks to our panel, Bill Rolley from Texas Capital Bank, David Matthews from RevTech, Jeff Williams from Interlock, and J.R. Garcia from Green Park. By the way, J.R. and Innobot were students in the MBA Venture Practicum class that we had at SMU. So we are trying to create the next generation of venture investors as well. I want to thank the SMU support team and see you in January 20th, 2022. See you then. Thank you.